Quantum computing stocks are in absolute free fall in real time. Take a look. Rigetti Computing is down a massive 44% today. D-Wave down 36% today. What's going on here? But before we get into that, we need to talk about FOMO. FOMO, and especially in the stock market, is extremely risky. This is not a good strategy to look at something that's rocketing and go, oh my God, I need to get in. We've seen this happen over and over again when too many people start talking about something and there's over enthusiasm and people are overly excited. Usually it rips and then tanks. Now look, Rigetti is still up 790% in the last 12 months, but you can see right below that it was around $20 just a few days ago. Now this thing is in free fall. Same thing with D-Wave, up 588%, but dropping pretty hard. So if you bought one of these stocks 12 months ago, even though you're seeing a big hit today, well, you're still up. But when it comes to FOMO, that's usually not what happens. What usually happens is it runs and runs and runs until all of a sudden everyone's talking about it. Oh my God, should I get some? Should I get some? And they end up becoming what we call a bag holder. They buy at all-time highs when the smart money is going, wait a minute. Look at this. Rigetti rallying almost 1,500%, D-Wave 854%. What do you think the smart money is doing here, right? The guy who bought 12 months ago when it was a few bucks a share, or $1 a share, and they bought 20, 30, 40, 50,000 shares. You think that they're not looking at this massive run of, 1,400%, 800% going, whoa, in a year, this is crazy. I'm out, which is part of what we're seeing. But there's also this article that came out today after NVIDIA's CEO said that quantum stocks like Rigetti are 15 to 30 years away. The CEO, Jensen Huang, said if you said 15 years for useful quantum computing, that would probably be on the early side. If you said 30, that's on the late side. If you pick 20, I think a whole bunch of people would believe that. But 20 years is a long way away. Now, he goes on to say that he believes NVIDIA will play a very significant part in creating the computers and helping the industry get there as fast as possible. But as fast as possible, he's thinking 15 years is too early. 30 years is too late. 20 is more realistic. So it's that 1-2 punch of over-enthusiasm. It rips way beyond any sort of normal valuation because of hype and because of FOMO and all that shit. And then something happens, like a CEO coming out saying, hold on a second, or it could be something else, broadly speaking, like bad earnings. Or that's why high-risk speculative investing is so risky. The smart move when it comes to super high-risk investments is to look at it and go, I'm only putting in what I'm willing to lose. Because I don't know about this thing. They have no earnings, no fundamentals. It's purely speculative. Sounds interesting, though. Maybe I'll buy 100 shares. The goof is when the inexperienced investor comes in and goes, this is going to be the future and it's happening tomorrow. I'm going to put in my life savings and I'm going to get really rich and really fast because I missed out on Bitcoin and I missed out on this stock and I missed out on that investment. And that's when investors get hurt. Now, someone might say, well, in 20 years, these companies might be huge, but so I'm going to hold on to my investment or I'm going to buy this big dip. But the real question that I'd be asking is, are these companies even going to exist in 5 to 10 years? Or will other companies come and replace them? Will they go bankrupt? Will they turn out to be not as good as they said they were going to be? That plays into the speculation. So am I running out to buy this massive dip? Not yet, but things could change. We'll see. And remember, bulls make money, bears make money, pigs get slaughtered, and smart investors always smash that follow. See you later.